Financial independence means having enough money in invested assets or in passive income to not need to exchange your time for work. And a lot of us want to get there. So how do we do it? Hey y'all, I'm Kara Perez, founder of Bravely Go, and today I'm going to break down 3 different investing strategies to help you reach financial independence. Go ahead and give this video a like if that sounds awesome, or if you think my money jacket is really snazzy. I'm on track to be FI, which is short for financially independent, by age 42. I'm currently 34. So FI is something that I'm really interested in personally as well as professionally. Now, FI means a lot of different things to a lot of different people. There are various definitions floating around the internet of what it means to be FI, but for the purposes of this video, we're going to say that being financially independent means you have enough money to not need to work in any capacity. And today I've got 3 investing strategies to help you get there ASAP. Before we dive in, I just want to say one thing. I'm going to talk about aggressive investing strategies today. So the numbers and the strategies that you're about to see, these are a best case scenario and they are high by design. If you're aiming for FI, you can't use the same investment strategy as someone who wants to retire at 65 or 70. FI requires a little more flexibility, a little more creativity, because by design, it goes against the status quo, and you are trying to leave work earlier than normal, or at least have the ability to leave work earlier than normal. The right investment accounts that most people need to reach FI are going to be a workplace retirement plan if applicable, especially if you have a match, an IRA, a brokerage account, and an HSA if applicable. Now, if you're already stressed out just hearing how many accounts that is, or you're not sure what all of them are, take a deep breath. In through the nose, out through the mouth. I'm going to break it all down for you. You can open most of these accounts at any brokerage. I personally like Vanguard and M1. Those are the brokerages I use, and I'll link both of them in the description below for you to go check out if you want, but any brokerage will really do. Let's start with the workplace plan. So this is going to be something like your 401k, your 403b, your 457. I like these plans because they allow anyone who's aiming for FI to set up a really solid later in life investment plan. And what I mean by that is if you take advantage of your workplace retirement plan ASAP in your career, you can really stack a lot of money in your 20s and 30s that you won't be using until your 60s and 70s. So you're giving that money the best chance of growth over the long term. Also, workplace retirement plans, especially things like the 401k, which is the most common workplace retirement plan in the United States, have much bigger contribution limits than some other plans on this list. They have tax benefits, and they may even have something like a workplace match, which is where your company matches the amount that you're putting in up to a certain percentage, aka it's your company giving you free money. We love free money around these parts. Right now, the personal contribution limits to a 401k and a 403b is $20,500 per person. So if you're in a partnership, you can put $20,500 in your 401k and your partner can put $20,500 in their 403b. This is as of 2022. These limits do change every few years. So if you're watching this in the future, make sure to check the IRS website to see if that's changed. If you're able to max out your 401k, that's going to be $1,708 a month. And if you can do this consistently for 10 years, maxing out that 401k or that 403b, let's say you do it from age 25 to 35 and you get an 8% return, you'd have $296,916.58. It's not enough to completely retire on, but it is a fantastic base for that later in life money. Let's say at 35, you stop contributing to this account, to your 401k or your 403b, you just don't put in any more money, and you let what's in there compound over the next 30 years until you're 65. How much money do you think you're going to have? Drop your guess in the comments. And remember, this is just one account. If you just leave that $296,916 alone, you don't put anything else in there, and you continue to get an 8% return for the next 30 years, you are going to have $2.987 million by the time you turn 65. That's amazing. That's just in one account, and that really shows us the power of investing early and the power of compound interest. And I'm using an 8% return for all of our calculations here today. You'll often see people using a 10% return because that is the average that the S&P 500 has returned for the last couple of decades. So people take that. I like to be a little bit more conservative with my retirement estimations, and so I go with 8%. And even at 8%, this one account is basically at $3 million by the time you're 65. But of course, with our FI plan, we want to leave work earlier than 65, so we need a couple other accounts, which brings me to the IRA. IRA stands for Individual Retirement Account, and this is a self-directed retirement plan that is not associated with your workplace. Anyone who is 18 plus who has some sort of income can open an IRA. So if you're a 1099 worker, or if you have a W-2 job, or if you only work part-time, you can open an IRA. And that account is going to be attached to you as an individual. It's not going to be attached to your workplace. So if you leave a job, the account goes with you, as opposed to something like a 401k or a 403b. It doesn't automatically transfer with you, and you have to do paperwork to make that thing roll over, which I'll explain in another video. There are a lot of different types of IRAs, but today we're just going to talk about the traditional and the Roth. Both the traditional and the Roth IRA have a $6,000 personal contribution limit for 2022. The Roth has an income limit of $144,000 for a single person tax filer and a $214,000 income limit if you are married and filing your taxes jointly. The traditional IRA has no income limit, and you can deduct your contributions to your traditional IRA from your taxes. Generally speaking, and I mean very broadly here, y'all, the Roth IRA is better for lower income earners, and the traditional is better for higher income learners. Did I say learners? I meant earners. If you have a question about the differences between the two, or you're not sure which one is right for you, drop it in the comments and I will make sure to go in there and answer y'all. Now, I think everyone needs an IRA, pretty much regardless of what your income is or what your job is, specifically because it's not tied to your workplace and because they come with a lot of other perks that I really like. For example, you can take out up to $10,000 from your Roth IRA over the course of your lifetime, specifically to help with a down payment on a house. And you don't get taxed on that. That's not an early withdrawal, and you don't get penalized for taking that money out. And you can use it to purchase this other asset. I think that's really powerful when we think about putting together a wealth building plan. And now the brokerage account. So this is a non-retirement specific investment account. And again, anyone who is 18 plus with earned income can open one, and it is not tied to a workplace. So it has similarities with the IRA that way. But the first two accounts I mentioned, your workplace plan and your IRA, those are specifically retirement accounts. And you can't take money out of them unless it's for one of those special programs, without having to pay income taxes and early withdrawal fees until you're 59 and a half. That is not true for the brokerage account. And that's why for anyone who is striving for financial independence, a brokerage account is essential. Because if you're gonna let that money that we talked about earlier sit and grow to that $3 million, you need to have another account with money that you can pull out to pay the bills while you're waiting for that $3 million to grow. And finally, an HSA. So HSA stands for a health savings account, and it's not available to everyone. You have to have a high deductible health insurance plan in order to qualify for an HSA. The money that you put into an HSA is not taxed, and the current contribution limits for an individual is $3,600 or $7,200 for a family. Here in the United States, healthcare is a mess. There's really no other way to put it. We have a terribly hard to use healthcare system. So having something like an HSA in your FI plan can be really, really powerful and really useful. It allows you to save money for future healthcare costs. Now that we have the accounts, how do you know which one to fund first? Especially if you have a limited amount of money to work with. Investing for financial independence starts with building a solid retirement base. If you are going to leave work early in your life or in your career, you need to have enough in investments that will continue to compound during those years that you're not working to provide for older you. We don't want to leave 65, 75-year-old you out in the cold and the dark because we didn't invest enough when we were working. So here's your order of operations when it comes to funding these accounts. First, your workplace plan if you get a match. That means the employer is also putting money in the account. That's going to be our number one. If you do not have a workplace plan, I would say fund your IRA first. That's that $6,000. Then you're going to want to fund your brokerage account. Then you want to circle back to your workplace retirement plan. Remember, if you don't have that match, The workplace retirement plan is going to be number 3 on the list. If you do have the match, it's number 1 on the list. And then finally, your HSA. Now, let's talk numbers. How much should you be putting into these accounts? If you're seeing this part of the video, comment with "I'm investing" so that I know you are ready to get these numbers into your own accounts. Everyone's income and lifestyle is going to be different. If you are a single parent in LA, your money is going to look very different and your lifestyle costs are going to look very different from a 2-parent household in Iowa City. I don't want to say, if you don't invest $2,000 a month into each account, you're never going to reach FI, because that's not helpful for us, right? Instead, I want to use percentages. That way, the amount of money you're making is a little less important. You can just take the relevant percentage and plug in whatever that number is to these accounts. And of course, before I get into the numbers, I want to put a caveat in here to say that everything I'm about to share is best case scenario. I know that everything is getting more expensive right now. I know there are fears of a recession. I know inflation is sky high. So if you are spending more on the bare essentials in your life than you were a year ago and you don't have as much to invest, totally fine. I am not judging you. Do what you gotta do in your own life. Here are the percentages to aim for. 10% into your workplace plan, 10% into your IRA, 10% into your brokerage. And then your HSA, kind of a question mark, question mark, question mark, whatever you can if it is available to you. Now, as math whizzes will notice, that means we are investing at least 30% of our income, and that's high. Remember, getting to FI means being really aggressive with your investments earlier in your life. And like I just said, if you are only able to put in 10% just into your IRA, you can't do anything else because life's too expensive right now, that's totally fine. In fact, that's incredibly badass that you are able to do that, and you should be proud of yourself. People who reach FI all have one thing in common: consistency. They invested as soon as they could, and they kept investing through changes in their life, whether that was job changes, career changes, children, wedding, recessions. They kept investing. Now, it is an absolutely wild time to be alive, and a lot of people who have achieved FI that we see in the news or that we see on social media also have a lot of other privileges going for them. Many of them are white, many of them are straight, many of them are in 2-people households, so they have 2 incomes going towards the goal. I absolutely want to recognize that. But as you are on your own journey, I want you to focus on being as consistent as possible, as often as possible. Every month, try and invest something. If last month you were able to invest $1,000 and this month you're only able to invest $200, that's still awesome. Congratulations, you have checked off the box of being consistent. I want you to try and invest through recessions. I want you to try and invest through your own personal life changes. Getting money into the market is giving your money the chance to make more money. If it's not in the market, it's not going to have as good of a chance to do that for you. All right, what are y'all's plans for FI? How far are you from achieving it? How much are you investing a year in order to get there? And what accounts are you utilizing? I want to know absolutely everything about your FI plan, so let me know in the comments, and be sure to give this video a like and hit subscribe.